Hello and welcome you all to yet another edition of the Fund Manager interview with PMS Bazaar. I am your host Arvind Ravindran, and today we are delighted to have with us Mr. Arpit Shah, co-founder and director of CARE Portfolio Managers, a portfolio management firm with over 1,000 crores in asset under management, managing CARE growth plus value and large and mid-cap strategy. And today our discussion will be on these flagship products. As the founder, director and qualified chartered accountant, he brings over 18 years of rich capital market experience. As a first-generation entrepreneur, Mr. Arpit focuses on in-depth research and business development, playing a key role in driving the company's strategic growth and establishing a strong presence in the financial sector. Welcome, sir.
Thank you. Thank you very much.
Yeah. To begin with, tell us how do you view the current macroeconomic environment in India, sir, particularly growth, inflation, and interest rate dynamics, and what does it mean for our equity markets?
Yeah, so the macroeconomic environment for India seems positive, mainly because of above normal monsoon, which is one of the, for us, we believe that this is one of the biggest positive factor, mainly for rural economy, which was not doing well in last 2-3 years. Further, because of the good monsoon, inflation is into control, and there is interest rate. There are still hope of interest rate going down or maintain at the control same level. Similarly, considering that overall geopolitical issues, Indian government has done reasonably, like they stood by their point. So they are reasonably protecting domestic consumption, domestic economy. Apart from that, for macro, like GST reforms and individual income tax slab rate, increase of that all will help economy to grow further. However, looking at the overall scenario currently, we expect that we have to focus more on the particular sector in which focus more on the domestic economy and which are immune to global geopolitical uncertainty. We recently, like 2 days back only, we got very good news that post implementation of GST, Maruti delivered 30,000 cars in first day of the Navratri, which is highest in their history. Now, as far as the equity market is concerned, post-COVID, it was more driven by liquidity. Of course, fundamentals was there, but liquidity was driving the market. In last 1 year, equity market has corrected mainly to to see some cooling off period. Having this macro factor in mind, we believe that sector-specific approach, one should start looking for the investment.
Thanks for that perspective, sir. It's interesting to hear how you connect the macro backdrop with the equity market direction. On that note, let's talk about valuations. Do you think Indian equities have been trading at a premium to most global peers? If they are, tell us if this valuation gap is justified or should investors be cautious at these levels, sir?
Yes, our markets are trading at premium to global peers. However, that gap has been reduced substantially. As in last 1 year, our market has grossly underperformed the global peers. Like Nifty is down around 3%, whereas Nasdaq is up 26%, Hang Seng is up around 40%. So Indian equity markets have grossly underperformed, or probably the worst performer in last 1 year, and that has reduced the premium what we were commanding. However, India is in fastest growing large economy. Historical valuation will have to be adjusted towards the upward side. So if historically Indian markets were quoting at some 15 to say for example 15 to 20 times, we will have to give more premium to the fastest growing large economy.
Appreciate your take on this, sir, because valuations are always a tricky subject and it helps to hear your balanced view on whether this premium is a strength or a risk. Now, shifting gears a bit towards fundamentals and company performance. Tell us, when evaluating growth potential of a company, how much weight do you place on historical volume growth versus future revenue and margin expansions expectations, sir?
So market always works on the future. Unless a particular company or industry is grossly undervalued compared to the peers. Historical volume growth are or past performance are relevant only to judge the management capability, management execution capability. But it is not the deciding factor. Future can be immediate or long term as well. So depending on what time frame we are looking for, we have to take considerable call whether this growth is sustainable, whether this growth is momentum, and accordingly we can prepare the strategy for the portfolio.
Very well put, sir. That distinction between historical performance and forward-looking expectation really helps to understand how you assess opportunities. With that framework in mind, let's move to how CARE PMS looks for businesses with either zero debt or strong interest coverage, sir. Because in a country where leverage has historically supported businesses, how do you balance between conservative balance sheets and companies using debt strategically?
So CARE PMS philosophy is always there that business has to be cash positive. We always invest into businesses which are generating positive cash flow. Apart from zero debt, the strong interest coverage ratio, if there is a debt, is also we are looking for. As we speak, our growth plus value portfolio weighted average debt stands to somewhere around 1950 crores versus free cash flow of the business is 1975 crores. So that means we are quite conservative as far as the debt is concerned in the books of the company. We avoid companies who have negative operating cash flow, and because we also want company to pay regular dividend to its shareholders. And for CARE PMS, around 2% yield is through our dividend yield.
Interesting point to note, sir. And that naturally brings me to risk management because in today's volatile environment, it becomes even more crucial. As we all know, Indian equities have delivered a strong return since the COVID period, but the past year has been marked by heightened volatility. In such an environment, efficient risk management becomes crucial. So, can you walk us through the risk management framework that CARE PMS follows and how it acts as a shield for the portfolio, sir?
We have a different portfolio strategy, structuring strategy at different point of time. Like when there is a correction in the market, we have different portfolio structure. When we believe that it is at the beginning of the bull run, we have a different portfolio structure. So accordingly, we structure our portfolio. In extreme bull run, where like last year, what we did was we actually exited many of our small cap companies, or either partly booked or full 100% exit, and we deployed that funds into the large cap. That was one of the strategies that we implemented. Within large and mid cap also, we went for the companies which were immune due to the global uncertainties. Like we invested heavily into the pharma and oil and gas sector. So uh, depending on which market cycle we are, our portfolio structure depends. Right now, we are balancing our exposure. We are balancing our risk by having exposure into consumer discretionary spend companies.
Thanks for breaking that down, sir. It's reassuring to know how CARE PMS builds in strong guardrails to protect the portfolio, especially when markets get unpredictable. So, over the last 14 years, the CARE PMS growth plus value strategy has delivered, I think, 21% CAGR, sir, turning 1 crore into 15 crores. If you were to summarize this journey in just a couple of minutes, what key highlights would you share with us?
So thank you. I would like to add few lines to this. In last 14 years, we have seen three very sharp corrections. 11 financial year 11, 12, 14, 15, and pre-COVID correction, where our portfolios were down almost 35-40% from its peak. So after seeing all this correction also, if our returns are 21%, that we believe we are quite satisfied with our returns. Reasons behind this is we do not deviate from the fundamentals. For us, management is the most important thing to look into the company, and proudly I can say that not a single company in our last 14 years history has seen any corporate governance issue. Similarly, we are investing into business which we believe that it is a scalable and top line as well as the margin. At the same time, we are conservative valuer. So we are our weighted average, we are very much focused on our weighted average P of the portfolio. As we speak today also, our portfolio weighted average is 20, less than 20, which if you have more than 80% exposure into small cap is considerably low P. Uh, we like to invest for the long term, so we normally catch the themes, we like to catch the trends early, like we invested into everything last year, which we encashed very well. Currently we are investing into mining thing. uh, at the same time, we don't shy away from booking the losses. We have booked losses into many companies. That helps us to churn the portfolio and invest into better, bright prospect companies.
That's a fantastic journey, sir. The way you have highlighted the consistency and discipline behind those numbers makes the performance story even more meaningful. Interestingly, your growth plus value portfolio has around 60% allocation to small cap companies. How do you identify businesses in this segment that not only demonstrate strong growth potential, but are also available at attractive valuations, sir, which can often be quite challenging?
So in last 14 years history, our exposure to small cap has been above 80%. As I answered in your earlier question, because we felt that last year that small cap has given a good run up, we decreased our that small cap allocation, and now as we speak, we are again going back to our historical weightage to the small cap, and we will increase it to 80 to 90%. Normally, we try to catch the trend, which allow us to enter into particular company or sector at very initial stage. And if at all our judgment goes wrong, the losses are not much. For example, post election of 2024, we had strong belief that government in next 5 years will focus strongly on the agri sector, and a lot of funds from the other schemes will be shifted here, which exactly happened, and we encashed that rally. Further, for companies, we believe that a reasonable scale with good market share is key driver. Though our exposure are into small cap companies, I can name the few like Dawat, JK Paper, Arvind, Saregama, those companies. But those companies are industry leader in their particular segment. So if I talk about Dawat, that is LT Food, which has 8,500 crores sales, but 50%, they have 50% market share in US market. Similarly, JK Paper, having around 7,000 crores of top line, is having 25% market share in copier paper in India. So those are the very big companies, industry leader companies, but fall into small cap. So even in small cap, we try to invest into the industry leaders only, and we believe that re-rating also can happen, and the change of try to catch the trend early. So these are there are combination of things which is working well, and that helps. That is how our investment strategy and portfolio structuring decides.
Small cap investing often looks exciting on paper, sir, but the discipline you bring in by identifying quality businesses at right valuations really sets the foundation for sustainable long-term returns. And that also connects well with the broader growth story of India. Because my next question is, as India progresses towards its Viksit Bharat vision, which three themes or sectors do you believe will create the most sustainable wealth over the next decade, sir? And how are you positioning your portfolio to capture them?
So at CARE PMS, we have industry cap of 20% and company at the time of investment cap of 12%. So we don't have more than 20% exposure at the time of purchase in any particular industry. Post China ban, the recent rare earth mining crisis, we feel this is one of the sector which is crucial to our self-sufficiency and where there could be lot of focus from the government over the medium term. Further, good dividend yield and reasonable valuation in current market scenario gives us more confidence. At CARE PMS level, we have kept 20% as the ceiling for any theme to play. So any industry will have maximum 20% weightage. There can be mix of companies, industry leader as well as the laggard, but at the industry level, we will have 20% cap. However, CARE PMS growth plus value approach is more on the stock specific approach instead of theme play. So I will like to share two companies' name which we have recently started buying. First is Mahindra Logistic. Appointment of Mr. Hemant Sikka as CEO shows the importance as well as the inherent potential of the company. In his tenure, Mr. Hemant Sikka was the president of M&M's Farm Equipment Division. Further, considering the bright prospect of the industry, management guiding to increase their revenue by 3 times in 5 years and available at very cheap valuation. So we feel that risk reward ratio is quite favorable. Another company is CRM Silk. The core business of the company is providing shirting and suiting fabric. However, using the stable cash flow from the core business, company has ventured into retail B2C segment, which can be game changer if executed well. Initial execution of that strategy has been commendable. Strong balance sheet, good dividend yield, healthy ROCE, and available at only 15 times of its earning, and excellent brand recall gives us the confidence that downside is limited and strong upside potential is there.
Wonderful perspective, sir. It's fascinating to hear which themes you believe will drive wealth creation over the next decade. While we have spoken a lot about your portfolios, I would also like to touch upon the philosophy and structure of CARE PMS as a firm, sir. Because despite having a large and experienced team, CARE PMS continues to operate as a boutique firm with just two PMS products. Why have you chosen this focused approach, and how does it give you an edge over competitors who have multiple strategies?
So, CARE PMS is a promoter-driven company, and we always believe that our focus approach is allowing us to mitigate the risk in the market. And we take 100% accountability of all our strategies, our performance, our bad performance. And we believe that we have just crossed 1,000 crores of AUM, which is just tip of the iceberg, and lot of penetration is available. So we would continue to focus only on this PMS business. And these two strategies, we believe that it is enough market. We still are quite young player and quite small player, and we have good investable surplus. So we would like to focus there only. At CARE PMS level, our hunger is for high returns, and hunger is for multi-baggers. And those segments are normally available into small cap or mid cap categories, companies. So I think we will continue to focus on these two strategies only till we cross, say, another 4,000-5,000 crores.
The refreshing take, sir, because in an industry where scale often comes with complexity, your choice to stay focused really highlights your commitment to depth, specialization, and client-centric outcomes. With that, we have come to the end of this conversation. Thank you so much, sir, for joining us and sharing your valuable insights. We truly enjoyed having you with us.
Pleasure is entirely mine. Thank you very much, Arvind, and thank you very much, PMS Bazaar team, for having me on this show. Thank you.
To our audience, stay tuned for more such engaging and insightful interviews with PMS Bazaar. Until next time, goodbye.